All right. Hi, everyone. It's Alex Ward here on your bi-weekly Strategic Partner Education Moment series. This week, we have the pleasure of being joined by Nigel Kennett of Nigel Kennett Professional Corp. He is a chartered accountant here in Edmonton, but did come from Calgary. So for our Calgary people, he'll be able to still provide you some value today as well. Nigel brings a wealth of experience with him, and I think he's going to be talking a little bit about your primary residence and how that can work and take some tax advantages out of that. Nigel, I'm going to pass it off to you. The floor is yours. Educate us, my friend.
Perfect. Thank you, Alex. So, like you said, I'm a chartered professional accountant. I've been in the game for a number of years, working with small and medium-sized businesses and individuals. It's been a ton of fun. So, yeah, I'm an accountant, but I like to think that I'm more than just that AR guy that hangs out in the back. You'll have to forgive the yellow tie and purple shirt. My wife said that I look like the Hallmark logo, but Alex nailed it right on the head. So today we're going to talk about a few different things regarding your principal residence. So I'm going to go ahead and start sharing my screen. So principal residence, it's kind of a big deal. So in the next few minutes, we're going to kind of go through these main points. What is a principal residence, and is there an exemption? Do you need to report the sale of the principal residence on your tax return?
Yep. Your screen isn't shared.
Oh, it's not? Ooh, no. How do I share it?
Go onto the share screen button, and it should pop up a little window, and then you just click on which one, and then click yes to share it.
Sorry, one more time?
There's at the bottom, there's the share screen.
I don't see it. Oh, there we go. Okay. And this is why I'm not in IT.
There you go. Now you're shared. Yeah.
Perfect.
We are seeing staples.
Okay.
Perfect. Now we are seeing.
There we go.
We are there.
Whew. Okay. Here we go. Let's rewind a little bit. So the principal residence. We're going to be talking about these basic points. So what is the principal residence, and is there an exemption? Do you need to report the sale of the principal residence on your tax return? And what happens if you convert your principal residence into a rental property? So we're going to start with some definitions. So the principal residence is a property that you, your spouse, or your common law partner, or kids lived in at some point during the year. So at some point during the year means that you don't have to live in this property year round, just at some point. So a second property could be considered a principal residence, which is why you see sometimes with individuals or families, they'll own their home and then like a cabin. And so then depending on tax advantages and gains, we could allocate the principal residence between both of those properties to try and provide you with the best tax advantage, which is why you can only claim one property as your designated principal residence per year. So when a principal residence is sold, if that price is greater than the purchase, then there's going to be a capital gain. So a capital gain, for the most part, only 50% of it is going to be taxable. But if you lived in that property for the entire duration of ownership, then you don't have to worry about reporting a capital gain on your tax return. But the principal residence exemption is separate from the lifetime capital gains exemption. This is something that I hear quite often, is that people will say, well, I've got the lifetime capital gains exemption. Like, why do I have the principal residence as well? And the lifetime capital gains exemption is only for qualified small business shares that are held in a Canadian-controlled private corporation. So if you sell multiple properties or have other capital gains, that doesn't impact your capital gains exemption. They're totally separate animals. And if you got questions, then you can email me or phone me and we can chat about those. So when dealing with the capital gain, the principal residence exemption, there is a formula which you'll see posted up on the screen. So it's basically the number of years that the home is your principal residence plus 1, and then it's multiplied by the capital gain divided by the number of years that the home is owned. So they give you a +1 rule. This is the Income Tax Act. They give you that +1 just to give you some flexibility, because there's always going to be layover from disposing a home So let's go through a quick example. So imagine you had your house and you owned it for 20 years, but you only lived in the home for 14 of those years of ownership. You bought the house back in the day for $300,000, and then when you sold it, you got $400,000. Like your net proceeds were the $400,000. So we calculate your capital gain exemption because you don't want to pay tax on that full capital gain. So there you see the 14 years of ownership plus 1 multiplied by the capital gain of $100,000, which is your net proceeds plus the cost. And then you're dividing it over the 20 years of ownership. And so then the capital gain exemption then is $75,000. So that means that you don't have to pay or include that $75,000 as part of your income. And then the capital gain to report is only $25,000. We have that $100,000 capital gain. We take off $75,000 of the exemption, and leaves you left with $25K to report, of which only half you bring into income. So it's pretty good that you can claim the exemption because it reduces that taxable income for you. So now, the next question is, do you need to report the sale? So whenever you sell your principal residence, the answer is yes. You have to report that on your personal tax return. CRA has been pretty aggressive in this and has changed it. And this is only just recently because only a few years ago you didn't need to report your principal residence disposal. But now what's happening is that CRA, they just want to keep track of things. And then if you don't report it, they're going to penalize you. And they're quite aggressive in their penalties. They can go back several years to assess a penalty. Traditionally, they usually only go back 3 years from the date of the notice of assessment, but for the principal residence exemption and calculating penalties, they can go back almost indefinitely, and they can charge you $100 a month up to $8,000 for not reporting your principal residence disposal. And then they can still hit you with a capital gains tax on that. So if you don't report your principal residence disposal, then they can slap a penalty up to $8,000, and then they can tax you on the gain of it. So report the disposal of your principal residence on your tax return. But what happens if there's a change in use? So when we're talking about change of use, that's when we're talking about how you had your principal residence and then you converted it into a rental property. When this happens, there's usually a deemed disposition. And so what we mean by this is that the property now takes on a new cost. So for example, if you bought a house 10 years ago for $400,000 and then you turned it into a rental property last year and it had a fair market value of $450,000, then now we have a cost for that property of $450,000. And then we can use that for calculating a number of things, like on your rental income reporting, right? If there has been a change in use, or if there's been anything like that, then we can extend the principal residence exemption by 4 years. So if you remember how we took a look at that formula, the principal residence was X plus 1. So if you owned it for 14 years, we tacked on an extra year and gave you 15 years to calculate what your exemption would be. We can file an election to increase that by 4 years, so then it becomes 14 plus 5 years. So this is really good for people who say they took on a new job in Vancouver, but they didn't want to buy a house in Vancouver. They wanted to rent their house in Edmonton. And so we can file an election where they're able to extend the principal residence of their house in Edmonton by 4 years, and then they can rent a property in Vancouver and then not be penalized for the additional capital gain that would have. So they can still hold their house and not face extra tax consequences on the disposal. Which is why, as we said earlier, like no other property can be claimed as principal residence during the same period. So it's not like you can move to Vancouver and buy another house and claim that as your principal residence and the property in Edmonton as principal residence. You can only claim one of the two. So as we said, it changes the principal residence exemption and increases it to 5 years. So let's go through a couple of examples. So this is an example where there was no election filed. So you owned a house again for 20 years, but you only lived in the home for 15, and then you rented the home for 5 years, and you didn't file an election. So you bought the house for $200,000, and then when you sold it, excuse me, yeah, you sell it for $400,000 after all is said and done. So the capital gain exemption in this case would be the 15 plus 1 times the 200,000, because that's what your capital gain is, the 400 less the 200. And in this situation, your capital gain exemption would be 160 grand. So the capital gain to report would be 40, of which only 20 is taxable. Okay. So it increases your income by $20,000, your taxable income by $20,000. But if you filed the election, this is where things get pretty slick, and you don't actually have to report that capital gain, right? So once again, you own the house for 20 years, you lived in it for 15, and rented it for 5. Same scenario, you bought the house for 2 and you sold it for 400,000. But then with the capital gain exemption, we're able to increase it from 15 plus 1 to 15 plus 5. And so then it multiplies by the gain, and the capital gain exemption is now $200,000. And so you don't have any capital gain to report, and your taxable capital gain is 0. So if you foresee some events in your life where you might have to move to another city to take on a new job, and you don't really want to sell your current house, but you know at some point you will, then always file the election, because then it'll extend that principal residence exemption by 4 years, which will reduce that capital gain. Like we see in the scenario, like it saved this fictitious individual $20,000 in income to report, which depending on your income could mean $10,000 in tax savings. So the real question is, should you hire a CPA, and is it worth it to help you file your tax return? Well, I'm probably a little bit biased because I am a CPA, but I think it's always worth it to talk to a designated accountant, because you want to share these big life events with your accountant, because they can help you with some of these tax planning tools. They can help you avoid incurring big penalties and other tax consequences from CRA by helping you report principal residence disposal on your tax return. They can help you figure out the best way to defer the capital gain if you're going to be moving to another city, or there's a change in use. A CPA is more than just that guy that hangs out in a room. They're the ones that help you with your life events, so that you can minimize your tax liability. I'm a strong advocate that everybody should be paying the right amount of tax, and in my mind, that is the least amount of tax. And you'll get that with a designated accountant. So that's my quick and brief presentation. So I'll open up the floor to any questions.
Let me just, I'm going to stop sharing your screen. Go to us. So there's one question. It's a very specific question, and it relates to the last part that you were just talking about. So condo owner, well, there's 2 questions. It's a 2-part question. Condo owners that bought in 2013 to 2016, they've definitely seen a decline in their condo value. So now if they're able to sell, they're probably selling at a loss, most likely. What's the advantages? Are there any advantages into actually selling at the loss, tax advantages? Or is there some better strategy in place for them to then be able to take advantage of that capital loss?
So with your principal residence, you can't actually claim a capital loss because it's recognized as being personal use property. So other personal use property would be like jewelry or a fine painting or something like that. So if you sell your house at a loss, then you actually can't do anything with that loss unless you have capital gains from personal use property. Like if you inherited a painting and sold it for a few $1,000s and there was a gain. This is a little bit wonky because usually when you incur a capital loss, you can carry forward those capital losses and apply them against capital gains. So for example, if you had an investment portfolio and you had $10,000 in capital losses in year 1, and then in year 2 you had $10,000 in capital gains, then the two would just wipe each other out. But if it was a personal use property that you owned and you sold it at a loss, you can't apply those capital losses against capital gains from other sources. So it's almost punitive. And so when we're talking about advantages, are there any advantages of selling? The hard reality is that it really just it hurts because it's that personal use property, and you can only apply that loss against gains from personal use property, which is very infrequent.
So if they had turned that personal use property into a rental and then sold a year down or a year or two down the road, would they then be able to claim a capital loss?
So what would happen is, because there's that change in use, the property gets reevaluated based on fair market value at that time.
Right, okay. So no.
Yeah.
Okay. Unless they change it to the use and then it continues to go down further afterwards.
Exactly. So if there's been a change of use and then the property continues to decline in value, then they can claim that capital loss because it's no longer personal use, it's an investment property now.
Right. And then this question is kind of related to your delay of the personal residence, where you turn the personal residence into a rental, but then you rent a secondary property somewhere else.
Mhm.
If you own the corporation that owns the secondary house and you rent from your own corporation, is that allowed?
So for example, Alex, like you had a corporation and your corporation owned a property in Vancouver and
Yep.
you're renting a property in Vancouver. No, it has to be arm's length.
Okay.
So because it's not arm's length, then you wouldn't be able to extend that. And then that extension of 4 additional years would be disallowed.
Okay. I think that's all the questions I have specifically about principal residence. I don't see anything else on here, but Nigel, let them know how to get a hold of you, because I don't remember you giving out your contact information or anything like that. So the crowds are demanding a
Let
way.
me share my screen again, because we jumped a bit too early. Here we go.
Just wait. You have to redo it because I took away your ability. You can do it now.
Oh man, it'll be the first time I've been disallowed.
Yeah, we're at questions again.
Bam, there we go. So this is the best way to get in touch with me. So you can send me a quick email. There's my email, Nigel at KennettCPA.ca. Or you can give me a ring at 587-438-6650. That's also my cell. So you can send me a text or whatever. And I'll answer. My wife usually gets angry at me because I spend more time on my cell phone than talking with her. But I love my wife dearly, and my cell phone is a close second, apparently. So,
that's good.
I am, yeah. Still,
and you still have to move.
Yeah.
That's even better.
Yeah. So I usually answer my phone at any time. So just give me a ring or send me a text, and I'll try to get back to you as soon as I can.
And the last question I'll ask you then, while still leaving up all your contact information, is what's typically your bread and butter client, or who do you like to work with the best?
Yes. So who do I like working with? I like working with individuals that are going through life changes and they need some help and some direction, and they just want to make sure that they're claiming all the deductions that they possibly can on their tax return. I like working with small and medium-sized businesses that are trying to grow and develop and maximize their cash flow and minimize the tax liability. Like I said earlier, I'm a strong advocate of making sure that businesses and individuals are paying the right amount of tax, because there's many businesses that sometimes just don't remember to sock away money for the tax man, and it kind of catches them off guard. And so I'm happy to work with them and provide them with tips of how they can better plan their tax liability and how they can minimize that tax liability. Do I have a specific industry in mind? I don't. That's a great thing about being a small practitioner, is that I've seen all sorts of industries. I've worked with lawyers and dentists and doctors and carpenters and welders and everything in between. So it's a lot of fun. I've seen a lot of industries, and I've got to know how many of them operate, and it brings me a lot of happiness to see how people's business grows. The other thing that I like doing is I actually am invested in their business, and so during this whole COVID crisis, I've been reaching out to my clients just to check in on them. So if you're looking for an accountant that actually cares you can give me a ring or send me an email. I'd be more than happy to share what I know and help you grow in the process.
Awesome. And final one, are you still helping businesses? Like, do you still look for business down in Calgary, or are you fully moved into the Edmonton area now?
Oh, I'm happy to take business down in Calgary as well. So that's the wonderful thing about technology, is that I'm happy to take a Zoom call, answer an email, pick up the phone. I'm even happy to drive down. I still have family down in Calgary, and so as much as I'd like seeing them, I'd probably prefer to see a client instead. So
That's awesome. Well, thank you so much, Nigel. It was fantastic having you on. Please do, if you have any specific accounting questions that we weren't able to get to today, I know Nigel is fantastic at responding and is quite open with his time. And so please do reach out to him. And as always, thank you so much for watching this week's Strategic Partner Education Moment featuring Nigel Kennett from Nigel Kennett Professional Corporation. See you guys.